A couple days ago, I made a video on this new 2x stock that I was buying, and unfortunately, that 2x stock continued to fall this past week. And that stock was Real Matters. If you've been following Real Matters, they were trading around $19 per share at the beginning of this week, but after their earnings calls, they dropped as low as around $15.90. So in today's video, we're going to be dissecting why Real Matters is actually down and what my opinion on this is right now. As well as I hope to give you a lot more information about Real Matters to help you guys who have paper hands not sell out so quickly. Because if you have paper hands, just like those people in GME or AMC, and when those stocks dropped and they sold off, well, they're at a loss. And eventually they're probably going to go back up next week. But enough about those two stocks, we're going to be talking about Real Matters today. If you guys are new here, my name is Daniel, and here on this channel, we talk about stock market investing with a focus in Canadian growth stocks. And Real Matters was a pretty big growth beast at the beginning of 2020. Its stock price started around $12 at the beginning of the year, and it shot all the way up to about $32 per share, I think, in the beginning of August. And since then, it's dropped back down to around $16.75 today. Before we get started, if you're new here, hit that subscribe button if you're interested in Canadian stock content, as well as I have a Patreon group down below. If you're interested in following my trades, you can sign up today, and there's honestly no pressure to do so, but if you want to see what I'm doing in the market in real time, then check that out. So first, talking about Real Matters and what their business is for those of you guys who don't know. So my understanding of Real Matters is essentially they're an Uber for mortgage lenders who are looking for appraisers as well as title search services. So these are two services that Real Matters platform provides, and they just essentially connect these professionals with the mortgage lenders. And they're sort of the middleman, just like Uber is for taxi drivers as well as people who need taxis. An appraiser is basically someone who goes to a house and checks it out on the inside as well as the outside and comes up with a value for the house. An appraisal is usually required by the lender in order to know that if the person who borrowed the money to buy the house can't pay the payments, then the lender can take the house and sell it on the market for a reasonable price to be able to recuperate some of their losses. So they don't want to over-lend for a house that's not actually worth that much. Then on the title search side, this is to make sure that the house as well as a piece of land has a clean title, meaning that it wasn't used in some sort of other loan, or there weren't some miscommunications in documents and actually who owns the land, as well as they also provide the escrow, which is essentially the transfer of funds from the seller to buyer, and a few other things on the title search side. So these are the two segments of revenue that Real Matters is in. To break things down a little bit further, on the appraisal side, they do refinancing as well as new home purchases. But on the title search side, they only do title searches on refinanced homes. The reason why they don't do title searches on mortgage origination is because a real estate agent usually has someone who can already help out the buyer to do that. So the lender isn't the one usually facilitating the title search. However, that landscape is starting to shift, and eventually they will get into the title search for mortgage origination. So now to talk about why the stock dropped. And it's pretty much the reason why is the past two quarters, the growth has been pretty lackluster compared to quarters before that. So this current quarter, the revenue grew at 15.9%, which was fairly weak compared to literally like 3 or 4 quarters ago when they grew revenues like 70%. In the past quarter, they also grew revenues by about 15%, and the quarter before that, it was 29%. So you can see that the past two quarters, they only grew revenues by 15% year over year, and the stock has been punished since then. If we break down the revenues by segment and look at the growth in each segment, the appraisal revenues are only at 3.2% growth compared to 2.7% last quarter, which was weak, 18.8% in the quarter before that, and 65.4% in the quarter before that. And the quarter was 65.4%, I believe that was pre-pandemic. Then also in the US title segment, growth slowed down at 39% for this current quarter, which is, pretty good for most companies. However, compared to last quarter, it was 45.9%. The quarter before that was 70.9%, and the quarter before that, pre-pandemic, was 108.3%. So we can see that the growth for the title segment has also slowed down, and this was our fastest growing revenue segment. So ultimately, this is the reason why I think that investors sold the stock off, as they saw in the short term it wasn't a very good play. However, I do have a long-term view for this company, and I think that right now, the prices are fairly cheap for it. Even analysts out there are saying the stock is worth at least $21 to $28. So we could easily see almost a 2x if this stock hits the price targets of these analysts. But I think another thing that plays into why people were fairly bearish on Real Matters in this past quarter is the fact that US home sales actually grew like dramatically. If we take a look at this graph here, we can see that home sales got hit when COVID came in around March, April, and May. However, they picked up quickly June, July, and then September it was actually better than last year. In October and November, December, we had very strong months for home sales. And people are probably scratching their heads as to why is Real Matters not doing well when home sales are basically skyrocketing right now. And the reason for this is twofold. On the appraisal side, they're not doing well because people can actually waive the need for an appraisal. And when people waive the need for an appraisal, they just basically go to the lender and look at other comparable houses to get a fair market value for their current house. They don't actually have a guy come into the house and inspect every single element and come up with a value that way. So there's a bit more risk doing that. However, they do save money if they waive the appraisal, around $500. So the criteria to be able to waive the appraisal was relaxed right now. So less people actually required appraisal services, and ultimately the appraisal segment of Real Matters didn't grow very much. On the title search segment, that segment is not really impacted by the number of new home sales because they're only servicing refinancing right now. And people right now are maybe on the fence about refinancing because interest rates are still low and they could drop even lower in the coming months. These are my speculations as to why the refinancing is down right now, so take that with a grain of salt. So I think the fact that people see that real estate is up as well as Real Matters growth has slowed down, these are two negatives for the business, and people ended up selling off this. And I think they don't really see the long-term vision, or they just think there's better value elsewhere in the market. There are a couple other concerns I want to highlight before I go into why I'm bullish about this company. The first one is management has been selling off shares this past summer when shares were at all-time highs. And personally, if I were management, I would probably do the same thing because they knew that their business got hit by COVID-19, yet the share price was boosted quite a bit. So I think from management's perspective, it was the right time to sell out of their shares. And the former CEO and founder of Real Matters, Jason Smith, has been selling off around 3,000 shares per week. The fact that he's doing a weekly share sell-off, this is a very small amount for him too. I think that this shows that he's, playing it a bit more responsible and not selling everything at once when the stock hit all-time highs. He wanted to do it in a more methodical manner to show that he still is a long-term believer, but he just wants to take a bit of his capital off the table because this is his first time that he's actually been selling shares, or at least one of the first few times that he's been able to sell shares. And for him, being in this business since 2003 or 2004, this is quite a long time to not sell off any shares. The next risk that I see is the fact that they have a new CEO, Brian Lang. And Brian Lang has been with the company as a COO since 2019. So he's been with the company for about 2 years or so. However, Jason Smith, he's still going to be there as the executive chairman to be able to guide the business along as they go through this transition period. So I have no problems with Brian Lang coming in because of his extensive experience just in the business world, especially with finance and stuff. He was a former CEO of MasterCard Canada, and he worked with MasterCard Canada in various positions for 13 years. But I think as a long-term investor, Real Matters is fairly undervalued right now. The fact that the company earned about $440 million in revenue and has a market cap of only $1.5 billion, this puts a PS ratio at around 3.5 or so. This is extremely low for this growing tech stock. Yes, their growth has slowed down a bit. However, I think there's only short-term headwinds from COVID-19 that are impacting their business. So now turning over as to why I still have diamond hands when it comes to Real Matters. So the first thing is, I think that right now investors are seeing Real Matters in the short term and selling it off. However, once we recover from the pandemic, the percentage of mortgages that have their appraisal waived is going to drop dramatically. And this should help boost their appraisal business and bring it back to higher growth. As well, with record low interest rates, once we come out of the pandemic, there's going to be a lot more buying of houses, I believe. So I think the appraisal market is going to balloon as well. And the fact that the number of appraisals that can be waived is going to shrink, this is only going to skyrocket their appraisal business and allow Real Matters to capture more market share. They already have 11% of the market for appraisals, and they're aiming to capture about 15 to 20% of that market. And think about all this data they can gather if they captured 15 to 20% of the market. And with this data where they're tackling home improvements and just home repairs, this is worth around $70 billion according to their estimates. This is a massive market compared to their appraisal segment and title segment combined, which they estimate to be around anywhere from like $10 billion to $15 billion. And speaking about the data business, this is a big reason why I'm bullish on Real Matters for the long term. I'll be holding the stock probably till 2025 until we get some more clarity as to how that plays out. I think that Real Matters has a plan in place that they're going to capture on this data, and I have no doubt in my mind that they're going to be able to find a way to monetize it. Whether it's themselves trying to go and sell these services through another arm in their business, or they're selling this data off to home renovation companies or just companies who provide these home products like washers, dryers, furnaces, roofing, and you name it. They have many different avenues that they can monetize this data, and this is going to be bigger than both their title and their appraisal segments. And I was listening to their investor day just a couple hours ago to understand how they're going to be tackling this and what's their plan going forwards into actually starting this data business. And the way that they painted the picture was right now they're looking for an acquisition to be able to help them get into this market. Preferably the company is already a data-driven type company, which has some sort of establishment in the market, but still small. And this company will be able to leverage the mass amounts of data that Real Matters collects from all their appraisers. And if we look at Real Matters financially, they've positioned them well to be able to do this acquisition at any time. It's going to take them a little while to find a good fit business to be able to merge with. In the meantime, they're going to be building up their balance sheet to be able to support this future acquisition, as well as buying back shares. And this is the next point that I want to make. Real Matters in this previous quarter bought back 1.2 million shares of their own and canceled them out. This equates to about 1.5% of the entire share pool. And I've noticed a pattern here. In the beginning of 2020, in the first 6 months, they bought back around, I think, 1.6 million shares each of those quarters, and the share price was trading around like $12 to $13 on average. However, in the summer months when the shares skyrocketed, they bought back around 94,000. So they significantly dropped back the amount of shares that they bought because they saw them as fairly expensive. However, in this previous quarter from September 30th to December 31st, the share price was quite nice. It was sitting around $22 and dropped down to $19, $18, or $17 per share. So they ended up buying back 1.2 million shares. And right now, with shares sitting around $16.75, I think they're going to be buying heavily in this quarter right now as well. So I expect to see a lot of support around the $16 level as they will continue buying back if people are selling off their shares. And they have a good balance sheet that enables them to do so. The last thing that I want to mention as to why I'm so bullish on Real Matters is their platform. The platform encourages competitiveness between the appraisers as well as those performing title search services. If you're a better performer, Real Matters will award you with more volume. And as they get more and more lenders onto their platform and they get more and more volume, they can essentially lower the amount that they pay out to their professionals and just give them volume instead. Because people would rather have volume than have higher margin single contracts. As a contractor, you prefer steady volume than big one-off hits. So this is one way that Real Matters is planning to increase their profitability going forwards. As they continue to capture more market share, they can bring in more volume, and the best of the best on their platform will be getting that volume. And the fact that this is a performance-based ecosystem encourages higher quality work. And with higher quality work, this earns them a better score. This earns Real Matters a better score with lenders, because the last thing that a lender wants is mistakes in these appraisals or in these title searches, which will cost them money to fix, as well as cost them more time, and possibly they'll lose out on a business to be able to provide a mortgage to a person. So I see Real Matters' approach completely different from the industry right now, which are usually just big companies out there who hire their own title search agents or their own appraisers, and they work on salary and have benefits, and it's just a very cushy job, and there's no purpose or no real drive to perform very well. People will move away from that corporate world to become independent contractors because it's a lot more lucrative. You're not paid a salary, however, the amount that you earn per gig is a lot higher. Because these big companies, they have a lot of overhead like HR and building costs, etc. As individual contractors, you don't have most of that overhead, so you can get paid a lot more as an independent contractor. So I hope this sheds a little bit more light on real matters. I know there's not much information out there except for on the company webpage and just all their investor presentations, which is a lot of material to go through. So that's what I did this entire weekend, just going through real matters, digging into the business and figuring out why this business is being undervalued by the market and where I see this long term. I honestly do believe the stock will be a 2x in the matter of 2 to 3 years, maybe even a 4 or 5x when we hit that data inflection point. And the reason for that is if we look at the target market for this data segment being around 70 to 80 billion dollars, this is like a 5x compared to the current market of the appraisers and title searches, which is valued around 10 to 15 billion dollars. So this is why I think Real Matters could easily 5x in 5 years, but in the next 2 to 3 years, I expect a 2x on my money. If you enjoyed this video and your paper hands turn to diamond hands, be sure to turn that like button blue, as well as subscribe, hit that notification bell if you're new here. I've got 2 videos on the screen here. You can check them out if you're interested. One of them is on Real Matters, and the other one is another growth stock that I'm super interested in. If you're there, I'll see you there. If not, keep up the grind and have a great day.